Welcome to EXP's Express Notes on CIMA P3 Performance Strategy. Today we're going to talk about foreign exchange risk, which is foreign exchange trading is a tremendously exciting area engaged by many market actors across the world. And of course, a lot of money can be made and a lot of money can be lost. The important thing for any company, finance director, CFO, treasurer, and so on, is to have a very clear understanding of what a company's foreign exchange exposures are, and therefore it's important for us to have a clear idea of defining the risk involved in when being exposed to the foreign exchange market. For example, a company winning a lawsuit that brings a guaranteed payment in the future of £1 million in 6 months' time means automatically, or by definition, that the company is now exposed to the foreign exchange market. Of course, we're assuming now that this is a company which is a non-British company and therefore is going to receive a currency inflow which is foreign to its own home reference currency, of course. The important thing is the timing, the realization here. Even though the cash flow is going to take place in 6 months, the company is exposed to the foreign exchange market. We could say it's long pound sterling, because if the pound were to go down in value, i.e. to depreciate, the company would suffer a so-called foreign exchange loss. Now, to mitigate this risk, there are things that the company can do. It can hedge its exposure. It can sell on a forward basis the pound sterling, which means that it's selling the pounds, offering to give them up in 6 months when they're received at a price to be established today. Of course, in this forward market, banks are actively involved and they're happy to provide quotations on such a trade. This is what we call an over-the-counter kind of transaction, because it involves bank and company as counterparties in what is a bilateral trade. When viewing and reviewing foreign exchange risk, it's important and useful to know some of the terminology in connection with this. For example, we speak of long and short positions, as we saw in the previous case with the £1 million. The company is to receive it, therefore the company is considered to be long pounds, even if it isn't already the holder or the possessor of the cash. A short position, on the other hand, is like having a liability in a given currency. If the price of that liability, of that currency, goes up, then the holder of such a short position would make a loss, and if the currency would go down in price, the holder of the short position would make a gain. It is, of course, possible in the forward markets to take a short position by selling something that you do not have effectively. This is something which often surprises people who are not acquainted with these markets and believe that, chronologically speaking, one must buy before one can sell, but that's not the case, of course, in the foreign exchange markets, or any markets which are dealing in futures or on a forward basis. Now, the other terminology that's useful here is to understand what the forward points mean, and this is simply a reference to the difference in the values of a spot price and a forward price. In this case, you see a 6-month forward price. The forward points are indicated here as being the differences between the spot and the 6-month forward bid and spot and 6-month forward offer prices. And there are useful tips here to be understood and to be learned in terms of how to build a forward price and to understand a forward price. Now, we're interested, of course, in the important task of managing foreign currency risk, and in particular to hedge the risk, to protect the company against loss in the foreign exchange markets. Now, there are some basic things that a company can do to protect itself. It could, for example, invoice in its home currency and therefore not be subject to such foreign exchange exposure. It can do clever things like netting off and matching various currencies so as to minimize the amount of currency exchanges that it has to make with the bank, and also figure out and manage its overall net exposure against different currencies. And it can also try to speed up the collection or delay payments depending on whether it expects some currencies to depreciate or to appreciate. So there is a certain amount of initiative that can be taken by a company in this area. Of course, as we have seen, there's also the possibility of entering into forward contracts, and there are other types of hedging instruments as we will examine immediately. In this syllabus, it's also important as one of the hedging strategies to understand how the money market hedge works. In other words, ask yourself this: if a company that wants to hedge and would have hedged in the forward market by buying or selling a currency could not obtain a forward quotation, how would they be able to construct essentially what is effectively a forward transaction by working with money market transactions and a spot rate? And in this case, where we have a company that receives the £1 million in 6 months, whereas we saw they could have sold the pounds on a forward basis, they also have the possibility of looking at a so-called money market hedge, which would involve the following steps. One would be to borrow pounds for 6 months. Secondly, sell the pounds for dollars, if that's the currency they want to ultimately end up in. And the dollars can be placed on deposits. So the borrowing and the placement are both cash market, means immediate market transactions. And we have a spot exchange here at the rate indicated between pound and dollar. And in this way, the pound is effectively given up by the company, and it knows precisely at the beginning how many dollars it will receive for its pound sterling. Now, there are other ways in which foreign exchange exposure, of course, can be hedged. Another important area frequently used is called currency futures. Now, unlike forward contracts, which are bilateral transactions between bank and client, i.e. an over-the-counter transaction, here we're talking about currency futures which are transacted over an exchange. And currency futures are essentially standardized foreign exchange transactions, forward transactions, and in fact they are priced in a way which is similar to the equivalent forward. In other words, as we say here, buying one contract of June euro futures against the dollar is similar to buying in the forward market euros. And if the euros futures contract has a standard size of 100,000 euros, then it's equivalent to buying in the forward market with a similar settlement date, 100,000 euros. The important thing here is pricing. It's pricing these transactions. So if we were to come back to the original illustration with the company expecting to receive pounds after 6 months, we identify here a third possibility for the company to be able to hedge itself against the pound going down. And what the company can do is to sell sterling denominated futures in an amount sufficient to cover its exposure. One can see here, in this case, the number of contracts that need to be contracted, given that the sterling contracts have a standard size of 62,500 pounds, and there's a £1 million exposure to be hedged. Therefore, this involves 16 contracts. The example goes on to show how the sterling futures contract is closed out at the time, in this case by buying back the 16 contracts that were sold in the sterling. This is winding up a position that the company has entered into with the exchange, and the idea of closing out a position can be seen here. This is in this with these illustrative rates, one can see what the impact has been on the company. There's also a definition of a tick value. This is capturing the smallest movement in price possible on a typical futures contract. And of course, when contracting with the exchange, companies would have to deposit margin with the exchange to cover the exchange against any default risk of the client. The exchange is always tracking the client's open position and marking to market the position so as to cover itself against the price risk. If a client is moving into a potential loss, then the exchange will protect itself by asking possibly for greater deposits, i.e. higher margin to be deposited with it. Settlement risk is thus excluded in the case of currency futures because the exchange has, of course, sufficient margin to be able to cover itself for any positions that are closed at a loss. And another way of reducing the loss is to prescribe a settlement of the difference, to close the contracts and settle for the difference instead of delivering the full amount of one side of the contract to the counterparty. Currency swaps is yet another way in which companies can protect themselves against currency exposures. Long-term currency swaps are illustrated here in the case of a company, a US company that's looking to develop a business in Japan and needs yen finance. And just to make the swap, to show that there are natural counterparties to such a swap, there could be Japanese companies that need to use dollars over a longer term period. Here we're talking about long-term swaps over several years in which the counterparties can profit by, or benefit, better said, by swapping the currencies that the other one needs at the beginning of the transaction, and then at the end of the swap transaction to swap back the respective currencies. And here one can see the details of a theoretical so-called fixed for fixed currency swap. It's a complicated area, of course, but it's a technically an interesting area and deserves a good deal of careful review based on numerous specific examples to understand how these instruments work and how they are created in the first place and how they are settled in the end.